Good to be with you, everybody. Great turnout here this afternoon. Thanks, Melissa and Jennifer, for getting the word out about Cindy being with us today. And of course, Cindy, thank you for carving out time for us on what we think is a very important topic and something that is of keen interest to the agents and advisors, particularly in the state of New York or licensed in the state of New York, doing business in New York. This is a day, or this is a time that we've been waiting for some time, the ability to get the new CareMatters 2 product in the state of New York. So we're pretty happy about this, and it is really getting a lot of buzz in the state of New York. It's getting a lot of buzz here in the agency, as I'm sure Melissa and Jennifer would share as well. So you're going to hear a lot more about it. We have a couple of events coming up that, as an aside to that, you want to be aware of if you're not already, which I think everybody is probably aware. I know that Melissa and Jen both, and myself, we have been putting the word out there about our upcoming LTC Carrier Days the first 2 weeks of June. So if you're not on board with those yet, you should be able to fish out the invite for that. If not, just reach out to any of us and we can get that out to you. So if you're in state of New York or state of Pennsylvania, even if you're in New Jersey, northern, central New Jersey, we're going to be in Harrisburg, PA, and then in the Philadelphia, PA area. And then we're going to be in four different spots here in the state of New York: Long Island, Westchester, here in the Clifton Park area where we're located physically, our home office is, and then out in Syracuse, out in central New York. So we're going to have some really great meetings going on, and this new product is going to be center stage, I'm sure. I don't want to steal Cindy's or Kyle's thunder, who will be both with us at alternating, I think, locations, as I remember. But good stuff in addition to what you're going to hear today. So thanks in advance, everybody, for being with us then. I will also mention that this Thursday, we've also been promoting our involvement since we're here with Cindy from Nationwide. Many of you know Sean Britt, who heads up their advanced markets area related to long-term care planning at Nationwide. She is once again going to be on the docket with me at the Pierre O'Connor and Strauss Elder Law Forum this Thursday in Albany. Now, it's physically taking place in Albany at the Desmond, the Crown Plaza Desmond near the airport here in Albany, but they're broadcasting it over the web as well. So even if you're not in the immediate Albany area or Capital Region area, you can join it online, and it's some really good stuff. It has to do with more than just insurance. It's not just an insurance meeting, but if you have questions about anything going on, in particular in the state of New York, but it really translates to other states as well, but particularly in New York with regard to elder law, elder care, extended chronic long-term care. This is a really terrific meeting where a bunch of different disciplines get involved, and it really gives you some great perspectives on the challenge that New Yorkers are facing and the role that insurance can play in helping solving a lot of those problems. In fact, that'll be the topic that Sean and I will concentrate on. Cindy will be there for that as well. So we were just joking that we're going to have Cindy change her residence to here in upstate New York. She's been doing so much with us and will continue to do so much with us. So really appreciate your time, Cindy. From a housekeeping standpoint, as usual, we've got the lines muted, gang, but if you do have questions, either through the chat, excuse me, chat or the Q&A, we'll keep an eye on both of those. So go ahead and submit any questions. Just be as specific as you can if you do have questions, because I know Cindy is going to move fairly quickly through her content. And then we will record the session as we typically do, and we'll put it up on our website, so you'll be able to check into it later if you want to revisit any of the content as well. So with that, I will close my rather large mouth and get to our featured guest today. You see that both Jennifer Brown and Melissa Frazier are on the screen with us. Everybody knows Melissa and Jen. Don't hesitate to reach out to them. You know what great resources they are. We're here to make your lives as easy and simple as possible when it comes to long-term care planning, and then specifically with the new CareMatters 2 product. So thanks for everything, Melissa and Jen, that you do. Thank you, Cindy. With that, I'm going to go ahead and turn it over to you. Welcome. Good to have you here. The floor is yours.
Absolutely. Thank you. And thank you to Melissa and Jen for being with us as well. As Bob said, phenomenal partners, and definitely, make it a lot easier for you all to do business. We know that this is a small part of what you do all day, every day. It's all that we do all day, every day. So definitely lean on the fantastic support team you have here when it comes to long-term care planning. I did just share my screen, Melissa, Bob, Jen, if somebody could just tell me they can see it. So I'm good to go.
Got it. Good to go.
Awesome. Thank you. Well, I appreciate you all being here. And Bob, thank you for the warm introduction. As Bob said, my name is Cindy Horwath, and I am the CareMatters wholesaler covering the entire Northeast. And I am based out of Philadelphia. Don't hold that against me. And, obviously it's been a tough go for a Philly sports fan. I'm hoping that the Phillies pull through. Flyers got swept, as you probably all know. The Sixers also got swept by the New York Knicks, but I got to give it to the New York Knicks. Yep, I see it coming up in the chat. I set myself up for that. Um, Got to give it to the Knicks. They showed up. They were resilient. They kept their foot on the gas, and they obviously came out with the win. And I think that that's kind of similar to what Nationwide did when it comes to bringing this new product to the state of New York. New York has historically been a challenging state when it comes to regulation and getting new products approved. But I'm really proud of our team for coming to the stage and coming to the forefront to make sure that we were able to provide the best in class strategies for your clients. And I think that's a testament to what we're doing at Nationwide, which is really this mission of expanding access to long-term care planning for all Americans, whether that's with CareMatters in New York, outside of New York. We also do have a product that's a little simpler underwriting. We're not going to talk about that today. But our goal at Nationwide is to just make sure that we're providing some of the best strategies when it comes to long-term care planning and making sure that we can expand access to these strategies across the board. So that being said, what we're going to talk about today is specific to the new product that we launched. So give me a moment here as I'm kind of flipping through. Can't talk about long-term care planning without just quickly going through why is it so important. Second, I am going to go through the differences between the old product and the new product, and then I'll give you a couple specific examples of how it really works between the old product and the new product. So just first, quickly, why is it so important to plan for long-term care? As you all know, being New Yorkers, it's expensive. Americans in 2017 spent close to $470 billion on long-term care expenses. That's nursing home, facility care, home health care, but it's also including all of the family members that have to take time out of work so that they can provide care to their loved ones, all the lost wages, lost income. And out of all those expenses, only 8% of the cost was covered by insurance. So Americans are still significantly underinsured when it comes to long-term care planning. And a big part of the reason why is because what we found at Nationwide is that when people think about long-term care, they're still thinking about, the worst case scenario. They're thinking about a nursing home when they're in a foreign place, they have a stranger that's coming in, they're poking and prodding them, and they're thinking, that's not what I want for myself. We found that 84% of people would rather receive care in their home for as long as possible. And that's what we're trying to do here at Nationwide, is to let people retire with dignity, but more importantly, retire on their terms of where they want to receive that care. One last thing before we jump into the differences between the new product and the old product is just a reminder when you're talking to clients about long-term care planning. A lot of times they'll kind of assume that they may have already been covered. When we did a survey, we asked people, hey, do you have any long-term care plan? And they'll say, yes, we do. I think it was like close to 70% of people thought they had long-term care. And when they dive into it, they're thinking of their health insurance. They're thinking of Medicare, Medicaid, long-term disability, none of which is going to be designed to cover long-term care, with the exception, of course, of Medicaid, which can, if you are, at a poverty level, essentially, and you're relying on government assistance. But outside of that, none of these are designed to cover long-term care expenses. So that being said, I'm going to kind of go through what hasn't changed, and then I'll go through what has changed. So what hasn't changed with the new products for CareMatters? The first thing is that we are still a cash indemnity plan. So you can use the benefit however you would like. So if you want to use it to make modifications on your home, to receive home care, pay your family members, obviously facility care, it's up to you. However you want to use your benefit, as soon as you qualify, you are able to do so. The other thing that hasn't changed is that we are still going to provide tax-free long-term care if you do need it, God forbid. We hope you never need long-term care. If you never need long-term care, you're going to have a death benefit that goes back to your beneficiary. And then there is some built-in liquidity. Not going to focus on that one quite as much because it's not going to be 100% liquidity, but there is some, if you wanted to surrender, you can get a portion of your money back. But more importantly, it's fully guaranteed. We can't come back and change anything once this plan goes into place. So none of that is changing with the new product. So then, Cindy, what is changing? There's a lot on this slide. Some of it I'll go through kind of as we're walking through an example of an illustration. But I do want to just point out a couple of the things that I think are really impactful and what we're really excited about with this new product launch. The first part is the inflation protection. So I know, I'm sure Bob, Jen, and Melissa, you all can agree with me. One of the things that we were most excited about with this launch is that we were able to make some enhancement on how the inflation works on our product. So just to walk you through it, on the old product, we had a 3% simple and a 5% compounding inflation adjustment, or there was just no inflation at all. The other caveat to it was that it was a little bit challenging. So the way that it would work, give you an example, let's say your client had a monthly benefit day one, $6,000 a month. 20 years from now, that monthly benefit is still going to be $6,000 a month. They have that for 2 years before it jumps into an inflated amount. And I'll walk you through an example. But as you can imagine, even as I'm going through that, it's confusing. It doesn't make a whole lot of sense. And not to mention, it's not keeping up with the rising cost of care, especially in the state of New York. So what we did is we were able to make an enhancement. One, we added a 3% compounding inflation adjustment. And two, the entire benefit is going to inflate from day one. So you no longer have to wait 2 years before the benefit's going to inflate. And again, I'm going to walk you through an example in a moment to kind of show you exactly what I'm talking about there. The other thing that I think is really impactful is the fact that we're able to offer separately identifiable premium options. So what that essentially does is it provides potential tax deductions for your business owners. So in the old product in the state of New York, we weren't able to separate out the life insurance and the long-term care premium, which is what's required for us to provide some tax deductions for business owners. But we were able to do that on the new product. So now if you have a business owner, they could potentially deduct some of their premium and still get a tax-free long-term care benefit. So more tax efficient on the front end as well as on the back end when they need long-term care. The other thing is the expanded funding options. So on the old product, we had single pay, we had 5 pay, we had 10 pay. We did also add 2 more options where they can do pay to 65 or pay to 100. So again, just trying to offer and open up the market to make it more affordable for more clients. And then the last thing I'll say that I'm really excited about is the fact that we're offering translation services. So we unfortunately have had situations that maybe you have experienced in the past. New York's a very diverse state. We have people from all walks of lives. And if they weren't able to complete the phone interview in English, we had to turn them away from that business. But we will offer translation services going forward. So if the client does want to complete that phone interview in their native language, they can do so on the new product. So those are a couple of things. And if you have those situations, again, Melissa and Jennifer, I know will be happy to make sure that you get the right forms to submit that. But those are some of the things. The last thing I'll mention is the reduced funding, or excuse me, the reduced issue age. So on the old product, it was from 40 to 75. We did lower it to 30 to 75. And I know what some of you are probably thinking, Cindy, not many 30-year-olds are thinking about long-term care planning. And you're probably right. They're thinking about funding their kids' college tuition, buying their forever home, making sure that their retirement's taken care of. But where we actually see a big opportunity for this is with higher net worth families. They know that they have a lot of legacy that they want to leave behind for the next generation. So we'll see sometimes some of those high net worth families actually leave it in the form of a long-term care policy through CareMatters for their adult children. And what that does is a couple things. One, it locks in their insurability so that they're going to make sure that they get this coverage when they're young enough and healthy enough to qualify. But it also provides a very robust long-term care benefit. So essentially their entire long-term care will probably be covered because they got this plan at that age. So those again are a couple of the things that I wanted to kind of share, but I do want to take a moment, and I know I stopped sharing my screen. Just give me one moment because I'm going to walk through some examples. And I see that the question is the product current age or age nearest? It is based on current age. So we would need the application submitted before the client's birthday, before they go to the next stage. All right, I'm sharing my screen again. You should be able to see that.
We can see it.
Perfect, thank you. So what I wanted to do is kind of, I talked through some of those changes, but I wanted to actually show you how it works. So again, reminder, everything is guaranteed. We can't change anything once this plan goes into place. But what we're doing here is we're looking at a 55-year-old male. I kind of talked about this inflation benefit and how it's going to be different going forward. So we're looking at a 55-year-old male. We saw for a $6,500 monthly benefit, total benefit day one of $500,000. In this example, that scheduled premium for one time would be $116,000. Now, what happens is it's a 55-year-old male. He's not going to need the care until he's age 85. So when we look there, the way that it worked on the old product, year one at age 85, he gets $6,500. Second year, he's still at $6,500 before it jumps up to $12,545. So that's kind of how the inflation used to work. Let me show you how it works on the new product. On the new product, again, we have a 55-year-old male. $6,500 is the monthly benefit day one. Total premium is $103,000. We're adding a 3% compounding inflation. The previous one was 3% simple. By the time they're age 85, the monthly benefit is now 15,777, 1.2 million worth of long-term care. So 15,000 immediately. You don't have to use $6,500 and then kind of kick into the additional long-term care benefit, the inflated benefit. So that's one example. Because I don't want to show you any like cherry picking or anything, I wanted to show you another example to just kind of walk you through another situation. This is a 60-year-old female. We're solving for the same $6,500 monthly benefit. In this case, the premium is 123,000. Again, we go down to age 85. The first 2 years, the monthly benefit is 6,500 before it jumps up to 11,570. Now, if we take a look at the new product, in this case, it's going to be more expensive. So 126 versus 135,000. But again, the trade-off or the benefit is going to be, instead of having that $6,500 monthly benefit for 2 years, she's immediately getting 13,000 for long-term care immediately. So that's what we're really excited about. So yes, there may be some situations. I just wanted to kind of go through two different scenarios where the long-term care, or excuse me, the premium might have gone up a little bit, but the trade-off is that the benefit is going to be much more robust. I do see that we have a hand raised or a question popping into the chat. I don't know if we're able to let people come off mute to ask questions or if they should just drop them in the chat.
Yeah, Bill, it looks like you had your hand raised. I'm not sure if that was because of your New York Knicks comment or if you did have a question. I'm going to go ahead and let you unmute if you want to ask your question verbally.
Unless it's about the Knicks, then we'll just put you back on mute.
All right, not responding. We do have some questions in the chat. Cindy, real quick while we're here. Sarah, of course, asked if it was current or age nearest. You answered that. John is asking if it's a single pay, what is the minimum initial deposit?
Yeah. So we have to back into a monthly benefit of $3,500 to determine how much it's going to be. I say that because it's going to vary depending on the client's age and gender. Depends. I had a case where the minimum was about 70,000. Some clients, it might be closer to 50,000, but it'll depend on how much it costs to get them to that minimum benefit.
Gotcha. And Bill did acknowledge that he doesn't have a question. He's just a Knick fan like me.
Yeah, okay, that's fair. One other thing I did want to point out on the differences from the new product versus the old product. You may have run into this situation, maybe not, but I do want to kind of share that on the old product, in this example, the client was doing 123,000 in a lump sum. If that client said, you know what, this sounds great, but I'd rather pay it over 10 years, we would just take that $123,000 and divide it over 10 years, and that's what their their annual payment would be for 10 years. It is going to change on the new product. So the new product, if we wanted to keep that benefit the same, we mentioned it was 135,000 day one. If they wanted to pay it over 10,000, or excuse me, over 10 years, they would pay 17,000 over a 10-year period of time. So it would be 170,000 versus the 135,000. So there used to not be a pricing difference depending on how long you're paying the premiums, but there is now going forward, which is how it works on the rest of the country for other product as well. So that does it for the product changes. Bob, Jennifer, Melissa, anything that I missed or anything that you want to make sure that I touch on from that standpoint?
So there's a couple of questions, and then I'll make a comment too, if you don't mind, Cindy. Dan is asking, how is the paper app done remotely? And then Dan also had a follow-up, if someone is on the old plan, how could they convert to the new plan?
Yeah. So paper application being done remotely, actually, Melissa and Jennifer probably know better than I do on how that process typically works with you all. So we'll kind of come back to that unless Jennifer, I see, came off mute.
Yeah, I can talk to that. So I can work very closely with you to help you go through the application to make sure you don't miss anything. But what a majority of our agents do when they're doing them remote is they work with the client on a Zoom or over the phone, fill out the application, and then send them via email the signature pages, the client images them back. Certainly you can do it through the mail, but we can't do e-app here in New York. So that's pretty much how the agents do it. You can DocuSign it on your DocuSign software, but I would advise you when it comes back to me, if you're missing a page of the quote or you're missing something, I can't tuck it in there because DocuSign, it records the amount of pages. You have to be really careful if you're going to DocuSign. You can always send me an application that you filled out prior to signature. I can look it over for you and give you the okay to send it to your client for signature. I'm more than happy to help you any way I can. I also have a cheat sheet that I made up for the New York app, going over all of the frequently missed items. Agents miss the same items all the time, and I have noted those on a sheet. So reach out to me and I can get that to you.
Awesome. Yeah. You have a fantastic team here that will make sure that that goes as smooth as possible for you. Melissa, was there something you wanted to
Two
add?
quick things, Cindy, if you don't mind, I'll interject with. I see that Joe has a question with respect to CareMatters. One, Joe, sorry, but the old product can't be written any longer. He was asking if there was still a window. There isn't. I will tell you though, there's so many perks, Joe, to CareMatters 2. Some cells are even a little less expensive than CareMatters 1, and others are really not that, not that much different. So reach out to us and we can certainly help you position, Joe, the CareMatters 2 for sure, and provide any quotes as necessary. And one of the things that I don't want to forget to mention, and you definitely glossed over the federal tax deduction for the long-term care portion of the premium, which is huge. There's a page right in the illustration that says this much is the life insurance, this much is the long-term care. Well, hence where we sit in New York, not only is there that federal deduction if a business is funding the premium, but don't forget we have that awesome 20% New York state tax credit. So in New York, 20% of your premiums are a straight dollar for dollar credit against what you owe the state of New York. So in essence, that's 20% off the long-term care portion of the premium, just not to exceed $1,500 because that is the cap on the state credit. But Jen and I can certainly, I don't want to get into the weeds with the tax benefits, but that's also a super play as well, that we did not have that luxury in the first CareMatters product. So honestly, Joe, to your question, even though we can't write it, by the time you take that 20% state tax credit on a good chunk of the premium, it's definitely going to probably be, a net cheaper premium for sure.
And I think too, Cindy, let me add, and I want to make sure that we answer Dan's second question, which had to do with the converting from the old plan to the new. Is that possible? But I also want to add, yeah, it's two things to keep in mind. There is also an income qualification that comes into part of the New York part of the tax credit now, which we want to be careful of. But it's still the most attractive state tax-based credit or deduction in the country, in my view. So very much worth talking about now, especially with the ability, because correct me if I'm wrong, Cindy, the bigger part of the premium is going to be the long-term care portion, right? So generally speaking, the long-term care portion of the premium is going to be a higher percentage of the total premium than the life. Would you agree with that?
Correct. Yep.
Yeah. Mark has a question. Going back to a prior point, so there now is present value discount if someone wants to do a 5-pay or a single pay versus a 10-pay?
Yep. So it would be a discounted amount if you pay it all up front versus if you pay it over time. Yes.
Hope that helps answer your question, Mark, and Dan, both of yours. Bart is asking, sorry if I missed this, my computer was not cooperating. Is the product available for groups?
It is not.
Yeah,
That
it's
is
an
something.
individual product, Bart.
Sorry, what was that, Bob?
No, it's an individual product, Bart, and
Yeah.
really
Yep.
isn't structured for a multi-life platform either.
Right. Exactly. And the other question, I don't know if we completely answered about being able to convert from the old product to the new product. So if you had somebody that it probably almost, I've had a couple of situations where people wanted to maybe look at the new product versus the old product, and it almost doesn't make a whole lot of sense because they're usually older. Health might have changed, underwriting might not come back as favorably. So you can maybe look, but it almost doesn't make sense, especially because when you factor in how much they're giving up in terms of what their cash value is. So again, that would be something to run by Jennifer and Melissa, but it probably makes sense if they already purchased it, it's already in place to kind of leave it. As premiums are guaranteed not to increase on the pay, our premiums not guaranteed to increase, correct? So premiums, if they did the pay to 65 or the pay to 100, it's still guaranteed, would not change. And is that the same policy issued in Connecticut? So this product that we talked about today, the CareMatters 2 in New York, it is a little different than the product that's outside of New York. The biggest difference, you will see a pricing difference. So if they're outside of New York, the premium may be a little bit less than it is inside of New York. But other than that, for the most part, everything is very similar.
As a follow-up, we're getting a couple of questions on taxes, as you can tell, Cindy. Let's connect off the line. Rich had a follow-up question. Does a sole prop in New York State qualify for the business tax credit? The short answer is yes, Rich. We have a couple of guides available. Melissa and Jennifer can supply them to you that, kind of give you the flow chart, if you will, of how you actually take advantage of that credit. So certainly can help with further detail there. Steve is asking, I assume, rates, and then we're going to move on after this just because we're great questions. We'll come back to them at the end. We won't limit them, but I assume rates are based primarily on life tables. I'm not sure if that's true. How is the difference between male and female rates weighted by gender?
Yeah. Yeah. And that it is a little bit of life, but it's actually more long-term care from a pricing standpoint. So women are actually more expensive for long-term care given their longevity and higher likelihood of needing care. So you'll typically see if you were looking at a male and female the same age, the female is going to be more expensive. All right, so we'll kind of go back just real quickly through, quite frankly, I only have a couple more things to share. I think we covered most of the product stuff. So just a reminder, when it comes to actually using the benefit, I kind of touched on it again, cash indemnity. In order to qualify for their long-term care benefit, they either have to be unable to perform 2 out of the 6 activities of daily living or have a severe cognitive impairment, Alzheimer's or dementia. And they would have to satisfy a 90-day waiting period or elimination period. Just as a reminder, this is how it works on the old product. This is how it works outside of New York as well. That 90-day elimination period is retroactively refunded once it's been satisfied. So what that essentially means is, let's say you had a $10,000 monthly benefit. The first 90 days you didn't receive a check from Nationwide. On the 91st day, you're going to receive a check of $40,000. $30,000 to make up for that elimination period and $10,000 to make up for that 4th month going forward. So once that criteria is met, again, the benefit is being used however you would like. And let me go again, cash indemnity, no receipts, no reimbursement. So really going to just close out with why Nationwide, and then we can open up to any other questions that people might have. So again, working with Nationwide, mutually held company. So our policyholders are the ones that kind of hold our, who own our company. We are an A-rated company, but we're also in the business of paying claims. And I say that because we don't do just long-term care insurance, but we also do, property insurance. We do, auto insurance, commercial real estate insurance, life insurance, annuities. We do a lot of different things. We wear a lot of different hats. So when it comes to partnering with a company like Nationwide, our goal is to make it easy as we can on the front end from a new business and an application standpoint, but also make it easy and friendly for your clients and their families when they're actually going to need this benefit for long-term care. They're buying this for something that they probably aren't going to need, hopefully, for 20, 25, 30 years. And you want to make sure that they're partnering with a company that they feel confident in. So that actually does it for the prepared remarks that we had. I did want to just close out by saying, when it comes to where do we start? I know you all are busy. You're going to go back to, what you're going to do. If you had a case that you were looking at in the past and didn't make a lot of sense, maybe they didn't really understand how that inflation thing worked, it might be worth revisiting and seeing if the new product is going to move the needle for them going forward. So that does it for my remarks. Any additional questions or anything else that I can touch on for Bob, Jennifer, or Melissa?
Yeah, a couple came up. Mark had a follow-up. Is that the same for policies issued in Connecticut? And I think he was referring to the discounting on the premiums, 5.
Oh, sorry. Yes.
Yep.
Yep.
And then he also asked if he said Together One. I think he means the CareMatters Together product. Is that available in New York? And I would say I like your thinking, Mark, but I think that Cindy's going to verify that Unfortunately, that product is not available in New
It is
York, at least
not.
yet.
It is not. No, not yet. Maybe someday. I mean, just like we kind of stay committed to this one, hopefully we'll be able to get something in the future. But what I will say, and I'm sure Jennifer and Melissa know where I'm going with this, we have a non-resident form for some situations where maybe they have a residence outside of the state of New York, or if they have, other situations that they may be able to use another state for their issue state. But they might not need to anymore because the product in New York is pretty similar to how it works outside of New York.
True enough. The other thing I did want to mention earlier, and while I'm mentioning, can you bring up the sample illustration that you had, Cindy, that had the
Sure.
different columns, including the IRR column?
Yeah.
And the reason I say that is because I think this is a powerful column to use, especially when you're looking at it from a should I insure or not standpoint, that the client that is. Because I think I'm still getting to this day this notion that I can, pardon me, self-insure, which is an oxymoron. More than likely, I can self-fund the cost for care. And for some people, the answer is you can. And I think we'd want to ask the question, would you really want to? But there are a lot of people who think, well, I'll just self-fund it or self-insure, but they don't realize what they'd have to do if they tried to replicate the benefit coming out of the insurance. And this IRR on total benefit column that you see on the right, I think can be very powerful in that regard. Now, keep in mind that not only this is a very conservative product. These are guaranteed numbers. Correct me if I'm wrong, Cindy. So this isn't well, let's see how the market goes, or, maybe we'll do okay. So that's number one. Number two is these are after tax numbers. So these are numbers that reflect the fact that if you take money out of this policy to pay for long-term care expenses, it's not income taxable most of the time. If you get over a certain limit and you don't have expenses to offset it over the per diem amount, maybe you got to pay a little bit of tax. But in most instances, it's not even going to be income taxable. The reason I point that out is because not only are these internal rates of return, the IRRs, very attractive, but you would have to back in a taxable equivalent yield to try to replicate that if you were to try to save or invest the money and duplicate what the insurance is doing. So if you throw in, even a modest tax bracket of 25 or 30%, and I think you could make a case for doing a little higher for a lot of your clients, even at a 25 or 30% combined income tax rate, think about how much more you'd have to do. You'd have to do upwards of 9+% on that side fund or that self-funding or, pardon me, self-insure fund to duplicate the benefits that are being provided in this product. I don't know that I would be comfortable doing that, especially knowing, once again, these numbers are guaranteed. This is a very attractive option out of the gate, but then when you start comparing it to, well, why don't I just do it myself? I don't think you can do it yourself. So I just wanted to mention that.
Absolutely.
I don't see any other questions. I don't think I see anything else in the chat area as well. So Melissa, Jen, I'll give you both a chance to kind of make any final comment, and then we'll let Cindy do the same, and then we'll cut everybody loose.
Hey, Jennifer here. I just want to mention one other thing that I don't think that we touched on, that 1035 availability. It's just easier now in New York where we can put in a 1035 that might be a smaller amount. We can use that to reduce future premiums, do a 10 pay, let's say, where we could only do it as a 1 pay before in New York. So if you can think of anybody who has old cash value and old life policies, and they only have, 10, 20,000. That's okay. We can put it in year one. We can reduce future premiums with it. The other thing I want to mention is everyone's real excited about pay to 100. You have to be 65 and under. I'm not sure if we talked about that. And any underwriting questions that you have, please reach out to Melissa or I. We can go out to the underwriter at Nationwide and make sure that we're not going to get any auto declines. They do have an underwriting book also now, height weight chart, medications you want to stay away from. Be very, very careful with any physical therapy. We want that to usually be about 6 months out. So don't be afraid to reach out to Melissa or I. We will go right to the underwriting department and see if we can apply for that person or maybe what the waiting period would be. And that's all I wanted to add.
Thanks, Jen.
A couple quick things that I'll mention, Jen, and yeah, I was going to mention the pay to age 100. That was a godsend with the new portfolio because it mimics a little more closely to a traditional long-term care sale. Maybe you don't have that client that is willing and able to spend $10,000, $12,000 a year for a 10 pay. But I had some quotes earlier today. Granted, it was a younger client. I want to say it was a 39-year-old that I ran about an hour ago. And I was really pleasantly surprised that the pay to age 100 was under $3,000 a year. So, keep in mind some of the sizzly things, especially I know we have some veteran folks that are on this webinar that have been doing long-term care planning for many, many, many years. Keep in mind that this is that old school cash indemnity, that we cannot get this on a traditional platform. They're going to cut you a check for the whole month. You can do whatever you want to do with the money. You can pay your loved ones to provide your care if you want, kind of a live, quit, or die. One way or the other, you're going to get your money's worth here. You're always going to get what you've paid in, sometimes more, back in the form of a death benefit if you passed on the night and never touched it. Yes, you can surrender, but people really aren't surrendering these policies because they're earmarked specifically for long-term care needs. But the long-term care piece, depending on the duration, could be 4, 5, 6 times what you're putting in that you have available, and the tax benefits and all that great stuff. So it's a really, really great story. And if we can work with you to make it an affordable premium, the clients are just going to love it. So, and then I know to dovetail what Bob mentioned earlier, our carrier day, we're going to have all the carriers that offer long-term care solutions present in, Clifton Park, Syracuse, Tarrytown, Long Island, Philadelphia, and Harrisburg, PA. So we're doing 6 cities. I highly recommend it. We're going to certainly get even more into the weeds with CareMatters for sure. We'll have a little bit more of a time frame there, and we would love to have you. So I'm handling all the registrations for that, and we do have some limited space at a couple of the sessions, but we still do have time for RSVP. So let us know if you'd like to, be there, as Bob and I would love to see you. That's all I got.
Thanks, Melissa. Appreciate it. Thanks, Jen. Cindy, I'll give you the last word before we finish up. Thanks again for being here.
Yeah, absolutely. No, I appreciate you all for being here and taking the time to, again, I know this is a small part of what you all do all day, but this is all that we do. I know Melissa, Jen, and Bob are fantastic partners for you all. So please lean on us. Let us make this as easy as possible for you. And if there is, Jen, you actually took the words right out of my mouth. If there's one place to start, those old life insurance policies, they don't really need it anymore. That's a great opportunity to revisit that conversation and see if we can get them something really meaningful. But that's all I had. Thank you so much.
Terrific, Cindy. Thanks a lot for being here, everybody. Hey, thanks for carving out time. Great turnout today. Hope you found it worthwhile. See you at the carrier days, if not before. Take care, everybody. Thanks again.
Bye.